Stop IRMAA Ambush, the 5-step RMD playbook to stop 50% tax and slash Medicare premium. Missing one RMD can spike your taxes, trigger extra Medicare premiums, and quietly drain 6 figures from your nest egg. And the deadlines, tables, and forms feel designed to make you slip. You're not crazy, this is tricky. Here's the fix: a tight 5-step RMD playbook that blocks penalties, lowers taxable income, and slashes IRMAA. No jargon, just moves that work. Stay with me because step 3 is the money saver almost nobody uses correctly. We're moving fast. First, I'll show you the RMD trap that trips people up, then we'll rebuild your timing, shrink the number, and automate the entire process. The RMD trap, what's really at stake? Let's get crystal clear on why RMDs matter. If you own traditional IRAs, 401(k)s, 403(b)s, anything tax-deferred, the IRS eventually wants its cut. Required minimum distributions are the forced withdrawals based on your age and last year's December 31 balance. Done right, it's routine. Done wrong, it's expensive. You can face an excise tax on the shortfall, plus higher taxable income that pushes you into bigger brackets and IRMAA surcharges. The pain isn't just the penalty, it's the ripple. Every pre-tax dollar you withdraw shows up as ordinary income. That income can increase taxation of Social Security, trigger state-level effects, and cross IRMAA thresholds that raise Part B and Part D premiums for a full year. Because IRMAA uses a 2-year look-back on modified adjusted gross income, AGI plus tax-exempt interest, one sloppy RMD year can cost you for 2 premium years. Here's the calendar trap. In your first RMD year, the year you turn 73, you're allowed to take that first RMD by April 1 of the following year. Sounds helpful, but it's a sting. If you delay, you still owe your regular RMD by December 31 of that same year. 2 withdrawals in 1 tax year means higher income and higher IRMAA risk. If you're near a tier line, that double hit can push you over. Now the account mixing landmine. With multiple traditional IRAs, you can total the required amounts and take that total from just one IRA. That flexibility does not cross account types. You can't use an IRA to satisfy a 401(k) RMD, and each employer plan generally stands alone. Inherited accounts add their own rules. People confuse this, think they're covered, and end up short in the wrong account. Another blind spot is the balance snapshot. Your RMD uses the prior December 31 value. Late year rollovers and forgotten accounts at banks can distort the math or fall off your radar. If a tiny, old IRA doesn't make it to your list, you can miss its RMD completely. "I forgot about that one" doesn't fix it. Timing is where markets bite you. If you wait until December, custodians are slammed, markets can be jumpy, and charity mailrooms are slow. You're forced to sell at bad prices just to meet a deadline, and QCDs can miss year-end if the check isn't issued and mailed in time. December should be verification month, not action month. The stealthiest part is how RMDs raise income just enough to topple other dominoes. More Social Security becomes taxable, certain deductions fade, state taxes may go up, and IRMAA with its cliff-style tiers can jump for the entire year even if you cross by $1. That surprise shows up as a higher monthly bill, not a friendly warning. So how do we take control? Build a single RMD control sheet, 1 page that lists every pre-tax retirement account, IRAs, SEP, simple, each 401(k)/403(b)/457(b), and any inherited accounts. Custodian, account suffix, beneficiary, and contingent beneficiary. Prior December 31 balance and this year's correct divisor from the IRS Uniform Lifetime Table, or the Joint Life Table if your spouse is more than 10 years younger and sole beneficiary. Calculated RMD per account, total IRA RMD, and which account will actually pay. Withholding plan and bank destination. Status boxes, calculated, scheduled, paid, and matched to the 1099-R. This one sheet turns uncertainty into a checklist. You'll see instantly if you're exposed to a double RMD year, whether your total might push you over an IRMAA tier, and which account is the cleanest source for distributions. You'll catch orphan accounts and track confirmations so your 1099 RS match what you expect in January. Operational sanity, don't wait until December. Set an annual RMD week in September or early October. During that week, you update divisors, confirm last year's balances, calculate totals, schedule distributions, and line up QCDs if you give. Then add a 2-week follow-up to verify everything posted. If something's off, you've got time. And yes, document beneficiaries annually. It doesn't change this year's RMD math, but it prevents inherited account chaos and death year RMD mistakes later. Clean titling today saves your family from painful, taxable fixes. Let me give you a quick win you can do today. Create your control sheet and fill 3 lines: the accounts, last year's December 31 balances, and your age for this year's divisor. Even that partial sheet reveals exposure, old accounts you forgot, employer plans that can't be aggregated, or an RMD total that looks uncomfortably close to an IRMAA tier. Here's the mental shift. We're not treating RMDs as a December chore. We're treating them as a fall project that sets your taxes and Medicare costs for the next 2 years. Once you see it that way, you stop reacting and start steering: smaller forced withdrawals, smoother income, and no penalty letters. Now that we've mapped the trap, we'll fix the clock so you never face a double-year surprise and you keep IRMAA in check. The RMD clock, deadlines, ages, and the first-year confusion. Now that you've mapped the trap, let's fix the clock. RMDs start when you hit the trigger age, currently 73 for most people. Your first RMD year is the calendar year you turn 73, and from that point you owe a required amount every year. Simple idea, but the first-year grace date creates confusion. In that first RMD year, you're allowed to take your first RMD by April 1 of the following year. That sounds generous, but here's the sting. If you delay the first RMD into next year, you still owe your second RMD by December 31 of that same year. 2 RMDs in 1 tax year. That can bump your income over an IRMAA tier and raise your Medicare premiums for a full year 2 years later. Unless you have a clear reason and you've run the math, take your first RMD in the same calendar year you turned 73 to keep a clean annual rhythm. After that first year, the rule is straightforward. The deadline is December 31 every year. There's no April 1 option anymore. If December 31 falls on a weekend or a holiday, your custodian's real cutoff may be earlier because processing teams aren't working on New Year's Eve. Treat December as a safety net, not a working month. If the distribution isn't out of the account by year-end, it doesn't count. Now the still working exception. If you're still working for the company that sponsors your 401k or 403b, and you don't own more than 5% of that company, you can generally delay RMDs from that current employer plan until you retire, subject to the plan's rules. That exception does not apply to IRAs, and it does not apply to old employer plans from previous jobs. So if you've got a couple of dusty 401ks from prior employers, they follow normal timing no matter what you're doing now. Let's make the operations crystal clear. A sale inside your IRA is not an RMD. A transfer between IRAs is not an RMD. For an RMD to count, money has to leave the IRA to you or go directly from the IRA to a qualified charity if you're doing a QCD. If the check is payable to you and you later donate, that's not a QCD and it won't reduce your income. For QCDs, the custodian must issue the payment directly to the charity, and it needs to happen by year-end for that year's benefit. Here's the workflow that keeps timing tight. Pick a permanent RMD week in September or early October. During RMD week, you pull last year's December 31 balances, confirm your age-based divisor, calculate the per-count amounts, and decide which IRA pays the total if you're aggregating. You also line up QCDs, get charity names, addresses, and amounts ready so those go first. Then schedule distributions and add a follow-up reminder 2 weeks later to verify completion. If anything hiccups, bad address, bank link expired, beneficiary mismatch, you've got weeks to fix it calmly. Rollovers need extra care. Your RMD is calculated using last year's December 31 balances. If you moved an account this year, the new custodian won't have last year's balance history on screen. You still need that number for the calculation. And if you're moving funds from an employer plan late in the year, many plans require the RMD to be paid out before the rollover. Confirm with the plan administrator so you don't accidentally move funds that should have been distributed. Keep this timing checklist on your control sheet. First RMD year, the year you turn 73. First year option, April 1 of next year, but beware of creating 2 RMDs in one tax year. All later years, December 31 hard deadline, no grace. Still working exception, only for your current employer plan if permitted, not for IRAs or old plans. Personal hard stop, treat November 15 as your finish line so December is only verification. RMD week, same week every September or early October with a 2-week follow-up. Now here's where most people mess up. They take a distribution in early January thinking it covers last year. It doesn't. They move money between IRAs and assume the transfer satisfied the requirement. It didn't, or they do a QCD but make the check to themselves and then donate. The exclusion is lost. Add in a late December scramble and you've got the perfect setup for missed deadlines and IRMAA bumps. Let me give you a quick win. Today, open your calendar and create 3 annual events: RMD week in September, a follow-up 2 weeks later, and a December 1 status check. In the notes of the September event, paste your timing checklist and add your custodian contact names and extensions. Share those invites with a spouse or trusted contact so you've got a second set of eyes. Once the clock is handled, everything else gets easier. You avoid the double RMD year. You leave room to execute QCDs correctly. You see IRMAA risk 2 years ahead and steer under the tier instead of reacting to a premium letter. With timing locked, we can now shrink the number itself so future RMDs are smaller and your income stays smoother. Shrink the RMD before it starts smart account positioning. Now that timing is locked, let's lower the number the IRS uses. Your RMD is a slice of last year's December 31 balance. Smaller balance in pre-tax accounts equals smaller forced withdrawal equals lower MAGI and less IRMAA pressure. We're not guessing, we're steering where growth happens and when income shows up. Why this matters: if fast-growing assets sit in your traditional IRA, you're compounding a future tax problem. If those same growth engines sit in Roth, you're compounding tax-free with no RMDs later. The thing most people miss is that what you own and where you own it are 2 different dials. Here's the practical model: 3 moves you can blend every fall. Move 1, measured Roth conversions in your low-income windows. Not convert everything. Convert up to the top of a bracket you're comfortable with, often the 12% or 22%, while staying under your IRMAA tier. You're shifting dollars from taxable later to tax-free, forever, and cutting the IRA base the RMD is calculated on. The shortcut nobody teaches: run an October MAGI estimate before you convert. Add Social Security, pensions, interest, dividends, realized gains, and any planned IRA withdrawals. Mark the IRMAA line for your filing status. Your space between that projection and your guardrail is your conversion capacity. Convert into the space, stop at the line. Move 2, Qualified Charitable Distributions once you're 70.5. If you give anyway, send it directly from the IRA to the charity. It doesn't hit your income, and once you're at RMD age, it counts toward your required amount. That's critical for IRMAA because deductions later don't lower MAGI. QCDs exclude the income up front. Do QCDs first, then take any remaining RMD. If you're married and both have IRAs, each of you can do your own QCDs. Keep the charity acknowledgement letters with your control sheet. Move 3, asset location, growth in Roth, steadier income and pre-tax, tax-efficient holdings in taxable. Keep equities and high-growth funds inside Roth so the upside dodges future RMDs. Hold bonds, CDs, and lower volatility income in the traditional IRA to slow that account's growth. In taxable, favor index funds and ETFs with low distributions, and harvest losses in rough markets to create space for a modest conversion without crossing a tier. You're not changing the total portfolio risk, you're placing it in the right buckets. Let me show you exactly how to implement this in 20 minutes. Step 1, open last year's tax return. Note your AGI and add tax-exempt interest. There's your baseline MAGI. Step 2, sketch this year's projection on your control sheet. List known income and any planned IRA withdrawals. Step 3, write your IRMAA tier line with a cushion. Don't plan to stop at the cliff. Leave room for mutual fund capital gains distributions that often arrive in December. Step 4, if you're charitable, schedule QCDs now and subtract that from what would have been taxable IRA income. Step 5. If you still have space, convert just enough to fill the bracket you picked without crossing your IRMAA guardrail, then stop. This clicked for a client when they realized their December extra $8,000 pull pushed them $1 over tier 2 years of higher premiums for both spouses. We swapped that $8,000 with a QCD for their giving, split the remaining cash need between IRA and Roth, and did a small October conversion inside the remaining space. Same spending, but MAGI stayed under the line and next year's RMD base shrank. Now where people mess up. They convert during a peak income year, double RMD, big capital gain or property sale, then blow through 2 IRMAA tiers. Or they park their Roth in cash for years while equities compound inside pre-tax. Or they do QCDs last after taking the taxable RMD. Flip that sequence. QCDs first, then the rest of the RMD, then consider conversions if you still have space. A quick decision tree you can use today. Are you 70 plus and giving this year? Root it as QCDs first. After QCDs, do you still need IRA income? Take only what keeps MAGI under your guardrail, top the rest from Roth or high basis taxable. Still under your IRMAA tier with room in your chosen bracket? Convert into that space and stop. Rebalance across accounts so equities live in Roth, bonds in pre-tax, and taxable stays tax efficient. Common mistakes to avoid. December conversions without a fresh MAGI estimate. Forgetting spouse coordination, 2 IRMAA exposures multiply mistakes. Taking an IRA distribution then trying to turn it into a QCD by donating later. The check must go directly to the charity. Ignoring mutual fund capital gains distributions and getting surprised in mid-December. Memory hook, broccoli in the Roth, fries in the IRA. Growth where it never raises future RMDs, steady calories where they won't balloon your base. Your quick win tonight. Write your IRMAA guardrail on your control sheet, add a 5-10% cushion, list your charities with correct legal names and addresses, and set a reminder to initiate QCDs before your scheduled IRA withdrawals. Then if there's space left, draft a modest conversion amount that fills your chosen bracket but stops below your guardrail. Do that and you've already shrunk next year's RMD before the IRS ever touches a calculator. Avoid the 25% penalty, the exact prevention checklist. Now that you've shrunk future RMDs, let's make errors impossible. We'll lock in numbers, sequence, and documentation so penalties and IRMAA spikes never show up. Start with 4 non-negotiables for each account. Last year's December 31 balance, your correct IRS divisor for this year, the calculated RMD for that account, and your total IRA RMD. Use the uniform lifetime table unless your spouse is more than 10 years younger and your sole beneficiary, then use the joint table. Confirm ages and beneficiary status on January 1. A wrong table quietly snowballs. Choose your distribution approach on purpose. Automation works when cash needs are steady and you're not doing QCDs or conversions. Set a single October payout or monthly withdrawals with withholding. Then verify annually that the amount updates for your new divisor and any rollovers. Manual pulls give control if you're coordinating QCDs, conversions, or IRMAA tiers. If you go manual, add calendar reminders and a 2-week verification step so nothing lingers in processing. Coordinate accounts correctly. Traditional IRAs can be aggregated. You can satisfy the total IRA RMD from one IRA. Use that to pull from overweight or least attractive holdings and to rebalance as you go. But employer plans stand alone. Each 401k and 403b generally needs its own RMD and you can't cover a 401k requirement from an IRA. Flag employer plans on your control sheet so they don't disappear in the shuffle. Set your withholding strategy early. You can use IRA withholding or quarterly estimates. A powerful trick, withholding from an IRA is treated as paid ratably throughout the year, even if you do it in December. That can clean up underpayment penalties. Just don't inflate the gross distribution more than needed. Run your MAGI math so withholding choices don't push you toward an IRMAA tier. QCD sequencing matters. If you're 70 plus and giving, do QCDs first directly from the IRA to the charity with your name in the memo. Keep the acknowledgement letter, then finish any remaining RMD. If you reverse that order, taxable RMD first, QCD later, you lose the clean MAGI exclusion. And remember, a check made payable to you is not a QCD. Document like a pro. Save last December 31 statements, screenshots, or PDFs of your RMD calculations. distribution confirmations with dates and amounts, charity letters, and every 1099R in January. Reconcile each 1099R to your control sheet, gross, taxable, and coding. If a 1099R is missing or miscoded, you'll catch it while the custodian can still fix it cleanly. Run an RMD rehearsal in September. Walk the entire process without sending money. Confirm balances, divisors, funding accounts, bank links, and charity details. Dry run your MAGI estimate against IRMAA tiers and note any rollover-related quirks. Then, in early October, execute and add a follow-up reminder 2 weeks later to confirm everything posted. Common tripwires to avoid. Thinking an internal sale or transfer counts. It doesn't. Cash must leave the IRA or go directly to a charity for a QCD. Letting dividends and interest accumulate and assuming they cover the RMD, they don't until distributed. Aggregating across the wrong buckets, IRAs together are fine, employer plans are separate. Missing tiny, dormant IRAs at banks. Add an orphan search line and call each custodian once a year to list all accounts under your SSN. Decide where the money comes from before you execute. Inside the funding IRA, keep enough cash or short-term assets to avoid forced selling. If you're rebalancing, sell overweight holdings to fund the distribution, then rebalance across accounts so growth lives in Roth and steadier income remains in pre-tax. That keeps your portfolio aligned while you meet the rules. Set premium safeguards. After distributions, compare your updated MAGI estimate to your IRMAA guardrail. If you're drifting close, shift any remaining cash needs to Roth or high basis taxable lots and pause elective income. If a life-changing event lowered your income, retirement, marriage, divorce, death of a spouse, loss of pension, note the SSA 44 appeal path and collect documents now so you can request an IRMAA adjustment when the letter arrives. Add beneficiary maintenance to the checklist. Review primary and contingent beneficiaries annually. Correct spellings, relationships, and SSNs. Clean beneficiary records prevent inherited IRA chaos, missed death year RMDs, and forced distributions that hammer heirs with taxes and higher premiums. Quick prevention win: print your control sheet, sign and date it after everything posts, and save it with confirmations and 1099 RS in your shared RMD plus IRMAA folder. If someone needs to step in, they'll have a map. If an auditor or Social Security asks, you've got clean evidence. Pros and cons lightning round. Automation, steady cash withholding handled but easy to forget QCDs or updated divisors. Manual, maximum control for QCDs and conversions but requires discipline and reminders. Either way, the rehearsal, early execution, and reconciliation in January keep you penalty-proof. One last micro story: a viewer set monthly automated withdrawals and forgot to reduce them after adding QCDs. We caught it in October, lowered the remaining taxable pulls, and avoided crossing an IRMAA tier by $400 of MAGI. The save wasn't luck, it was the rehearsal plus reconciliation. Run this checklist once and you'll feel the stress drop. Run it every year and penalties become a non-event while IRMAA stays where you planned: quiet. Missed it? How to fix a late or short RMD the right way. If you missed an RMD or came up short, don't freeze, fix it fast and clean. Step 1: take the shortfall right now from the correct account type. If it's an IRA miss, distribute from an IRA. If it's a 401k miss, distribute from that plan. Write down the date, time, amount, and account. That timestamp anchors your paper trail. Step 2: assemble proof. You need 3 pieces: the prior December 31 balance that drives the calculation, the math showing what should have been withdrawn using the correct IRS table, and the confirmation showing what you actually distributed late. Save screenshots, statements, and the custodian's confirmation. Label them clearly in your RMD folder. Step 3: write a short, respectful explanation for your tax file. Keep it factual. Identify the account and year, confirm the late distribution date, explain the cause, rollover timing, overlook small account, table confusion or processing error, and list the prevention steps you've installed. An annual RMD week in September, 2-week verification, a control sheet, and beneficiary review. The goal is to show prompt correction and a credible system to prevent repeats. Now make sure the cure fits the account. Traditional IRAs can be aggregated for the requirement, but the fix still has to come from an IRA, not from a 401k. Employer plans generally stand alone. You can't cure a 401k shortfall with an IRA pull. Inherited IRAs are their own lane too. Keep inherited assets in the inherited registration and distribute from there. Timing matters for taxes and Medicare. If you're in December, speed helps. A distribution on December 31 still counts for that calendar year. If you're already in January, accept that it raises this year's income and adjust the rest of the year to protect IRMAA. Use Roth or high basis taxable for cash needs and lock down QCDs early. Either way, correction beats delay. If you're charitable and still in the year, you can satisfy part or all of an IRA RMD via Qualified Charitable Distribution, but only if it's done correctly. The IRA pays the charity directly. You're at least 70.5 and it posts by year end. If you're cleaning up last year in January, QCDs do retrofix that. Use them for this year's planning, not last year's patch. Common errors to avoid while fixing. Rolling the missed amount. RMDs aren't eligible for rollover. Taking an internal sale or transfer and calling it done. Cash must leave the IRA or go directly to the charity for a QCD. Grabbing from the wrong bucket. Don't try to fix a plan RMD with an IRA distribution. Assuming reinvested dividends counted, they didn't until distributed. Once the money's out, update your control sheet. Mark the account, the calculation, the amount distributed to cure, and the confirmation number. Then add a bold note, RMD week locked September, and the follow-up reminders. This turns a one-time miss into a system upgrade. Let me give you a quick micro story. A client discovered in January that a $1,150 RMD from an old bank IRA never went out. We immediately withdrew $1,150 from that IRA, saved the December 31 statement, captured the joint life divisor calculation they should have used, and clipped the bank's distribution receipt. We wrote a brief note explaining the overlooked account after a move, attached the new control sheet and calendar proof, and consolidated that small IRA into their main custodian for better tracking. The correction was fast, documented, and we prevented the repeat by removing the orphan account risk. Watch your Medicare angle. If the late distribution lands in a year where you're already near an IRMAA tier, consider shifting the rest of your cash plan to Roth or high basis taxable, and route all giving through QCDs to keep MAGI below the line. If your income has permanently dropped due to retirement or another life-changing event, note Form SSA 44 as your path to request a current year IRMAA adjustment when the premium letter reflects the old higher income. When should you bring in a pro? If the miss spans account types, involves an inherited IRA, requires nuanced QCD sequencing, or combines with a double RMD year, a CPA or fiduciary advisor can thread the tax and IRMAA needles while cleaning up documentation. A short consult can save you thousands in premiums and penalties. Your never again checklist from here. RMD week in September with a dry run, no money moves, just verification. QCDs initiated first if you give. Employer plans flagged and handled separately. 2-week follow-up to confirm posts and resolve hiccups. December 1 status check, everything marked paid, beneficiaries reviewed, and MAGI still under your guardrail. January reconciliation, every $1,099 are matched to your control sheet. Final mindset shift, precision beats panic. Pull the shortfall now, document cleanly, and install the system. You'll turn a scary moment into a contained event, and your future RMDs will run on rails. IRMAA 101, how RMDs spike your Medicare premiums. Let's make IRMAA simple. It's an extra monthly surcharge added to your Medicare Part B, and if you have it, Part D Social Security sets it using your modified adjusted gross income MAGI from 2 years ago. For IRMAA, MAGI means your AGI plus tax-exempt interest. That 2-year look-back is why fall planning changes premiums 2 years later. Why do RMDs cause trouble? Because RMDs add ordinary income directly into MAGI. Cross an IRMAA tier by even $1 and you pay the entire higher surcharge for the whole year. These tiers are cliffs, not slopes. There's no partial penalty, it's all or nothing at each level. Here's the part most people miss. A one-time spike can hit you for a full year, and sometimes it's self-inflicted. Delay the first RMD into the next calendar year and you'll have 2 RMDs in one tax year. Add a Roth conversion or a big capital gain on top and you can jump multiple tiers. You won't see a warning. You'll see a higher Part B bill and a Part D add-on deducted from your Social Security. Let me back up and walk the mechanics. Each year, the IRS sends your tax data to Social Security. They take your filing status, pull your MAGI from 2 years prior, compare it to that year's IRMAA tier chart, and set your surcharge. They repeat that process annually, so you're not locked in forever, but there's always that lag. Plan now for the premium year after next. The real-world impact is cash flow. Part B premiums are monthly. Part D add-ons are monthly. If you cross a tier as an individual or a couple, you pay the higher surcharge each month for the whole premium year. For many retirees, that's hundreds per person per month. Over a year or two, that's thousands out the door. So what pushes you over? 4 common patterns show up again and again. 1. The double RMD year from delaying your first RMD. 2. Taking your entire RMD in December, then discovering mutual funds dumped capital gains distributions the same month, pushing MAGI higher. 3. Stacking a large Roth conversion on top of an already high income year. 4. Realizing big gains in a taxable account the same year your RMD is heavier, then forgetting tax-exempt interest counts toward IRMAA. Now, timing landmines. A distribution dated December 31 belongs to that year's MAGI. A QCD only helps if the custodian pays the charity directly by year-end. A reimbursement to you won't reduce MAGI. And mutual fund capital gains distributions often surprise you in December. If you plan to stop at a cliff, leave room for those. Here's the shortcut that actually works. Set a MAGI target band every fall. Not a single number. A band with cushion below the IRMAA line for your filing status. If you remember nothing else, remember this: IRMAA planning is about staying clearly under the cliff, not dancing on the edge. Let me show you exactly how to build your band. Step 1. List known income: Social Security, pensions, annuities, RMDs, interest, dividends, and expected realized gains. Add tax-exempt interest. Step 2. Layer plan moves: QCDs, additional IRA withdrawals, Roth conversions. Step 3. Mark your IRMAA tier line and set a buffer of at least a few $1,000s for year-end surprises. Step 4. Adjust. If you're near the line, reduce taxable IRA pulls, shift some cash needs to Roth or high basis taxable, and convert nothing this year. If you're comfortably below, you can still fill a tax bracket with a small conversion, but only up to your guardrail. The mistake I see constantly is thinking itemized charitable deductions solve IRMAA. They don't. Deductions happen after AGI. IRMAA uses MAGI. A QCD is different. It keeps the distribution out of income in the first place. That's why we do QCDs before any taxable IRA withdrawals when giving is part of your plan. There's also a release valve when your income drops for good. If you retire, marry, divorce, lose a spouse, or lose a pension, you can file Form SSA 44 and ask Social Security to reassess IRMAA using your current lower income. It's the official process. You'll need documentation, and it's not instant, so plan cash flow assuming the higher premium until the appeal processes. Quick win you can do today. Write this year's projected MAGI on your control sheet, pencil next year's, then the year after. Circle the nearest IRMAA line and add your cushion. If you're close, schedule QCDs now, smooth remaining RMDs across months if needed, and push elective income like conversions or big sales into a safer year. That single page turns surprise premiums into plan numbers. Bottom line, RMDs raise MAGI, IRMAA tiers are cliffs, and the 2-year look back means your choices this fall hit your premiums later. Keep a cushion under your tier, use QCDs to exclude income, and never stack conversions on top of peak years. Do that, and IRMAA stops being a mystery bill and becomes a line item you control. /IRMAA legal moves that lower MAGI. Now let's pull your premiums down legally and cleanly by lowering MAGI on purpose. We'll stack moves in the right order so you stay under your guardrail without trimming your lifestyle. Start with Qualified Charitable Distributions. If you're 70 or older and you give anyway, QCDs are the cleanest lever. The IRA pays the charity directly, the amount is excluded from income, and once you're at RMD age, it can satisfy part or all of your IRA RMD. Two rules are non-negotiable. The check must be payable to the qualified charity and you need the acknowledgement letter. Do QCDs first, then finish any remaining RMD. If you're married and both have IRAs, each of you can do your own QCDs. That's double the exclusion and often the difference between staying under a tier or not. Next, blend withdrawals across accounts to control what shows up in MAGI. Need $30,000. Maybe you take $12,000 from IRA after QCDs, $8,000 from Roth, and $10,000 from taxable high basis lots. Same spending, different MAGI. If you're within a few thousand of your IRMAA line, shift more to Roth or sell high basis positions in taxable to keep gains minimal. Then rebalance inside accounts so equities repopulate Roth and steadier income sits in pre-tax. Third, use measured Roth conversions only inside your IRMAA gaps. Conversions raise MAGI today, so you never stack a big conversion on a high income year. Instead, convert in years with room, pre-RMD years, a mid-year retirement, or a year with low dividends and realized gains. Your October MAGI estimate shows the space between your projection and your guardrail. Convert into that space to fill a bracket you're comfortable with, then stop. The win is twofold. You cut future RMDs and grow tax-free dollars that won't touch MAGI later. Fourth, smooth income timing. If you usually pull a full RMD in December, consider monthly or quarterly distributions after your QCDs post. Smoothing lowers the risk of landing on a cliff because of a late mutual fund capital gains distribution. It also gives you checkpoints to pause IRA income if you see MAGI creeping toward your line. Fifth, manage capital gains deliberately. In taxable accounts, harvest losses in rough markets to offset gains and be selective when realizing gains in strong years. If you're close to a tier, raise cash from high basis lots or from Roth to avoid bumping MAGI. If you have to sell with gains, trim IRA withdrawals to compensate. Your control sheet keeps the total under your band. Sixth, use the life-changing event appeal when eligible. If your income has dropped for good, retirement, marriage, divorce, death of a spouse, loss of pension, file Form SSA 44 with documentation and ask Social Security to reassess IRMAA using current income. Plan for a lag, but it's a real path to lower premiums when the old tax year no longer reflects your situation. Seventh, coordinate as a couple. 2 IRMAA exposures means one person's extra dollar can raise both premiums. Assign roles each fall, who QCDs, who draws more from pre-tax, and who converts. If one spouse is near a tier, shift their cash need to Roth while the other spouse uses QCDs to cut combined MAGI. Keep a shared guardrail with buffer, and adjust throughout the year if dividends or capital gains come in higher than expected. Let me give you a quick, repeatable sequence you can run every September. Step 1, project MAGI and mark your IRMAA guardrail with cushion. Step 2, schedule QCDs to match your giving from the IRA you'll use for RMDs. Step 3, plan your cash mix. How much from IRA after QCDs, how much from Roth, how much from taxable with minimal gains. Step 4, if there's room left and you want to fill a bracket, convert into the space and stop. Step 5, set monthly or quarterly pulls so you can course correct if surprises hit. Step 6, add a 2-week follow-up to verify QCDs posted and update your running MAGI tally. Common mistakes to avoid right now. Donating from taxable while taking a fully taxable IRA RMD. If you give, root it as QCDs. Converting after you've already crossed a tier, that's paying extra premium for no strategic gain. Ignoring mutual fund capital gains distributions that land in December, leave cushion. Forgetting the 2-year look back, this fall's MAGI affects premiums later, not next month. Your quick win today, write a 1-page IRMAA guardrail sheet and tape it to your control sheet. Top line, your MAGI target band. Next line, the IRMAA threshold you refuse to cross. Then your move order, QCDs first, blended withdrawals next, conversions only if there's space. Add your spouse's initials so you both own it. With that in place, you'll steer under the cliffs without guesswork. The 5-step plan, your annual RMD plus IRMAA playbook. This is the repeatable system you'll run every fall so penalties stay at 0 and IRMAA stays tame. Step 1, map everything on one control sheet. List every pre-tax account separately, traditional SEP simple IRAs, each 401k, 403b, 457b, and any inherited accounts. Add custodian account suffix, prior December 31 balance, and beneficiary plus contingent beneficiary. Note special rules like old 401(k) requires separate RMD. In the margin, write your filing status and current IRMAA thresholds with a small cushion number. Add 2 small boxes, orphan search and beneficiary review. Share the sheet with your spouse or trusted contact so there's always a backup. Step 2, set your calendar anchors. Create RMD week in September or early October. In the same week, open a QCD window if you're 70 plus and donate, and add a Roth window reminder for conversion analysis only if your MAGI projection has room under your guardrail. Add an IRMAA check to update your running MAGI tally and compare it to your tier lines. Then add a follow-up 2 weeks later to confirm postings, and a December 1 status check. Treat December as verification month, not action month. Step 3, calculate early and position holdings. During RMD week, pull last year's December 31 balances and apply the correct table divisor, the uniform lifetime table for most, the joint life table only if your spouse is more than 10 years younger and sole beneficiary. Compute per account amounts in your aggregated IRA total. Decide which IRA funds the total. Keep bonds or cash ready there so you're not forced to sell equities in a dip. If you're doing QCDs, stage the cash in the exact IRA you'll use. Rebalance across accounts so growth sits in Roth, steadier income sits in pre-tax, and taxable stays tax efficient. This alignment prevents last-minute selling and keeps MAGI predictable. Step 4, execute in the right order and document it. If you give, initiate QCDs first, directly from the IRA to qualified charities with your name in the memo. Save acknowledgement letters. Then complete any remaining IRA RMDs and satisfy each employer plan's RMD separately. Set withholding or quarterly estimates. Remember, IRA withholding is treated as paid evenly through the year, which can fix underpayment issues without adding MAGI beyond the distribution. Record dates, amounts, confirmation numbers, and bank destinations. In January, match every 1099-R to your sheet, gross, taxable portion, and coding so nothing is missed or miscoded. Step 5, audit and preview. On December 1, confirm every required account shows paid, every QCD letter is on file, your MAGI still sits under your IRMAA guardrail and beneficiaries are current. Then preview next year. Estimate RMDs using current balances, flag any tight IRMAA years, and identify low-income windows for measured Roth conversions. If a life-changing event will lower income, retirement, divorce, death of a spouse, loss of pension, note Form SSA 44 and gather documents now so you can request an IRMAA adjustment when the premium letter arrives. A quick one-page checklist ties it together. Top section, accounts mapped, orphan search, beneficiaries verified. Middle, calculate position, QCD first, then RMDs, then withholding. Bottom, IRMAA check, December 1 audit, January reconciliation. Keep this next to your control sheet, 1099 RS, SSA 1099, and SSA 44. Color coding helps: green for QCDs, blue for IRA RMDs, orange for employer plans, and a small surprise income buffer line to assume mutual fund capital gains show up in December. 2 pro touches make this bulletproof. Add a runbook paragraph at the top of your control sheet that explains your process in plain English so a spouse or adult child can finish the year if needed. And keep contact names and extensions for each custodian on the page. When you look organized, back offices respond faster. Run this exactly once and you'll feel the stress drop. Run it every year and your RMDs fund cleanly, your 1099 RS match, your MAGI stays under your guardrail, and IRMAA becomes predictable instead of painful. Special cases, inherited IRAs and beneficiary traps. Let's tighten up inherited IRAs so you don't fix your own plan and then blow it up as a beneficiary. The stakes are high. Different rules, different clocks, and mistakes can trigger taxes, penalties, and IRMAA spikes you didn't see coming. Start with the baseline. Most non-spouse beneficiaries who inherit now fall under a 10-year rule to empty the account by December 31 of year 10. That deadline is real. Depending on the decedent's status at death and evolving IRS guidance, annual distributions may also be required within those 10 years if the original owner died on or after their required beginning date. Translation: don't assume do nothing for 9 years and drain in year 10. That's how you create a 1-year income bomb that can jump multiple IRMAA tiers. Why pacing matters. Spreading withdrawals across the window smooths MAGI and keeps you under IRMAA cliffs. Equal slices work fine, but if you expect lower income in the early years, say you plan to retire in year 3, front load while you're still under your guardrail. If income will rise later, pull more now. The reason this works is simple. You're matching the tax to your capacity instead of letting it hit all at once. Eligible designated beneficiaries get exceptions. A surviving spouse, a minor child of the decedent until majority, a disabled or chronically ill beneficiary, or someone not more than 10 years younger than the decedent may use life expectancy payouts instead of the 10-year drain. For spouses, choices multiply. You can remain a beneficiary, treat the IRA as your own, or roll to your IRA later. Here's the shortcut. Younger spouse usually benefits from a spousal rollover to delay RMDs. Older spouse may stay as beneficiary briefly to use a favorable table, then roll at a better time. Multiple beneficiaries split the account into separate inherited IRAs by December 31 of the year after death. Separate accounts let each person follow their own pace and tax plan. Leave it pooled, and the oldest beneficiary's rules can drive the whole account. That's a trap you can avoid by pushing the custodian early for clean splits with proper inherited titling. Speaking of titling, get it right. Keep inherited assets in an inherited IRA titled something like beneficiary your name, deceased owner's name, DOD date. Don't commingle with your own IRA unless you're a spouse doing a spousal rollover. Mixing registrations can force immediate taxation or missed RMD issues that are a pain to unwind. There's a critical first step if the decedent died after their RMD age and didn't take that year's amount. The death year RMD must still be taken from the decedent's IRA before you proceed. Calculate using the decedent's divisor, distribute the shortfall, document it, then move on to your inherited plan. Skip this and you inherit a fixable problem plus avoidable letters. Let me show you exactly how to operationalize an inheritance. Step 1. Request the decedent's last December 31 statement, date of birth, date of death, and beneficiary designation. Step 2. Confirm whether the decedent was past their required beginning date. Step 3. If needed, take the death year RMD and document it. Step 4. Establish separate inherited IRA accounts by the deadline with clean titles. Step 5. Pick a 10-year pacing plan that fits your MAGI and IRMAA guardrail, equal slices, or a custom schedule based on your income path. Step 6. Add inherited accounts to your control sheet with their own timing notes and IRMAA impact. Common mistakes to avoid. Waiting until year 10 and triggering a single-year MAGI spike that blows past IRMAA tiers. Failing to separate accounts by the deadline, forcing everyone to follow the oldest beneficiary's rules. Rolling an inherited IRA into your own IRA when you're not a spouse, off limits. Ignoring the decedent's missed death year RMD, fix it first, then plan. Treating inherited RMDs like your own IRAs, aggregation rules don't cross buckets. Quick win you can do today: add a beneficiary review box to your control sheet. Confirm primary and contingent names, spellings, and SSNs, and keep a copy of your designations. If you're an heir today, call the custodian, ask for inherited IRA setup instructions and deadlines, and get a named contact. Clarity beats guesswork. If trusts, minors, disability status, or complex family dynamics are involved, bring in a pro. A short consult can prevent multi-year penalties, mangled titling, and unnecessary IRMAA surcharges. Clean titling, smart pacing, and disciplined documentation turn a stressful inheritance into a manageable plan. Married couples coordinating RMDs, taxes, and IRMAA. Let's turn this into a team plan. As a couple, you've got 2 RMD streams, 2 IRMAA exposures, and 1 shared MAGI target. The goal: keep both premiums in the same tier, and if one of you has to cross, do it intentionally while the other stays safely under. Start with a shared guardrail. On your control sheet, add 3 lines: spouse A projected MAGI, spouse B projected MAGI, and combined MAGI. Write your IRMAA tier line with a cushion. This instantly shows whether one person's move risks bumping both premiums. If you can keep both under the same tier, you protect monthly cash flow for the whole year. Now assign roles. Ask 3 questions each fall. Who QCDs, who draws more from pre-tax, and who converts to Roth? If one spouse holds the larger IRA and you give to charity, route QCDs from that account first to drop combined MAGI. If one spouse has more headroom under the IRMAA line, tilt more of the household IRA withdrawals to that person while funding the rest from the other spouse's Roth or high basis taxable. For conversions, pick the spouse with bracket space and more years until their RMD age, so you're shrinking the right future RMD. Here's the sequence that keeps you under cliffs. First, schedule QCDs from the spouse with the larger IRA directly from the IRA to charities before any taxable pulls. Second, blend withdrawals. Meet spending with a mix of IRA, post-QCD, Roth, and high-basis taxable weighted toward the spouse with room under the guardrail. Third, if you still have space, do a measured conversion for one spouse, never both, into the remaining bracket without crossing the IRMAA line. Survivor planning is the game changer. After a first death, the survivor faces single tax brackets and tighter IRMAA tiers. That's why bracket-filling conversions while both of you are alive can be smart. You're paying at joint rates today to lower the survivor's future MAGI and RMDs. Add a survivor preview box to your control sheet. Estimate the survivor's MAGI using current account sizes and Social Security decisions. If that preview looks tight, prioritize conversions now and accelerate QCDs from the larger IRA. Coordinate Social Security with RMD years. Sometimes delaying the higher earner's benefit to age 70 while doing conversions in those gap years keeps joint MAGI stable and builds a larger survivor benefit that's easier to support under single IRMAA tiers. If an RMD and a new Social Security benefit start the same year, double-check your fall MAGI projection with extra cushion. Here's a simple married couple cash mix example. You need $80,000 net. You route $12,000 of giving as QCDs from spouse A's IRA. Then pull $28,000 additional from spouse A's IRA, $15,000 from spouse B's IRA, $15,000 from Roth between you, and $10,000 from taxable high basis lots. Same $80,000 lifestyle, but combined MAGI lands safely under your tier. Afterward, rebalance so equities refill the Roths and steadier income sits in pre-tax. Beneficiary titling matters here too. Make each other primary, list contingents clearly, and review annually. If one spouse's pre-tax balance is much larger, consider splitting contingents to spread future tax loads across heirs with different income levels. And remember spousal rollover flexibility. After the first death, the survivor can remain beneficiary for a period or treat as their own depending on age and RMD timing. Common mistakes to avoid. Both doing big conversions in the same year and blasting through a joint IRMAA tier. Donating from taxable while taking fully taxable IRA RMDs from both accounts, use QCDs first. Ignoring the survivor's single brackets and missing the window to convert at joint rates. Taking both RMDs in December and getting blindsided by mutual fund capital gains distributions. Your couple's mini playbook. Set a shared MAGI guardrail with buffer and track A, B, and combined. Assign roles, who QCDs, who draws, who converts. Blend withdrawals to match cash needs while controlling MAGI. Run a survivor preview and convert at joint rates while you can. Align Social Security timing with your RMD and conversion windows. Do this together once each fall. You'll keep premiums predictable, taxes calmer, and the survivor's future simpler. Automation, checklists, and custodian coordination. Let's make this run on rails without going on autopilot. Automation should handle execution while your checklist handles thinking. That combo keeps money moving on time, records clean, and IRMAA under your guardrail. Start with assisted automation. Set a single scheduled IRA distribution in October or even monthly pulls if you like steady cash flow. But before you flip it on each year, update 3 items: your new divisor, the funding account, and your withholding percentage. If you rolled assets or changed beneficiaries, automation won't know, your checklist does. For monthly setups, confirm the annual total meets, not exceeds your IRA RMD after QCDs. If you do QCDs, schedule those first, then reduce the remaining automated taxable withdrawals so you don't over-distribute. Now build your micro checklists that live at the top of your control sheet. Keep it tight. RMD math, age, correct table, divisor, prior December 31 balances per account RMD and total IRA RMD. Funding plan: which IRA pays, QCDs identified, cash available, and withholding percentage. Execution: dates, amounts, confirmation numbers, bank links verified, charity acknowledgements saved. Compliance: beneficiary review, orphan account check, and SSA 44 readiness if a life-changing event hit. IRMAA guardrail: target MAGI range, tier lines, and a cushion for surprise capital gains distributions. Coordinate with custodians like a project manager. In late August, send each custodian a short message. Confirm last year's December 31 balance, verify primary and contingent beneficiaries on file, and request their QCD process and deadlines. Ask for a named contact and extension. If they mail QCD checks, confirm the exact payee format and address for each charity, and request tracking or confirmation when it's issued. Put those notes right on your sheet so you're not guessing in October. Bank links and withholding can save you. Test a small transfer to your checking account in early September. If quarterly estimates are short, remember IRA withholding is treated as paid evenly through the year, even if you do it in December. That can clean up underpayment penalties without new surprises. Just keep your MAGI tally updated so you don't raise gross distributions more than your IRMAA plan allows. Set 3 calendar anchors and share them with your spouse or trusted contact. RMD week in September, a follow-up 2 weeks later to verify postings and acknowledgements, and reconciliation week in January. During reconciliation week, match every 1099-R to your sheet, gross, taxable portion, and coding. The 1099-R won't label a QCD. You'll report the gross and exclude the QCD on your return, backed by the charity letters. If a 1099-R is missing or miscoded, contact the custodian while it's fresh. Create one shared RMD plus IRMAA folder, digital or physical. File names that sort themselves save time. Use a simple pattern like 2026 RMD Custodian Act suffix EMD PDF. Inside, keep prior December 31 statements, calculation screenshots, QCD letters, distribution confirmations, all 1099 RS, your SSA 1099, and a blank SSA 44 with notes on acceptable life-changing events and documents needed. Add your runbook paragraph at the top. A plain English summary of your process and custodian contacts so a spouse can finish the year if needed. A few pattern fixes prevent last-minute pain. Don't rely on mid-December mailed QCD checks. Mailrooms and holidays create misses. Aim for October. If you add automation, reduce it after QCDs so you don't overwithdraw and creep toward a tier. After a rollover, recalculate the automated amount. Your new divisor and balance make last year's number wrong. Keep a small cash sleeve in the funding IRA so a market dip doesn't force selling at lousy prices. Here's the quick win you can knock out tonight. Open your control sheet and add a reminders block. RMD week date, follow-up date, reconciliation week, custodian contacts, and your IRMAA guardrail. Then send one message to each custodian, confirm beneficiary status, and request QCD procedures. When responses arrive, copy details into your sheet and set a 10-minute task to verify bank links. Automate reminders, not judgment. Your checklist is the brain, automation is the hands. Together, they make this boring in a good way. Common mistakes that trigger penalties and IRMAA. Let's clear the landmines I see most often and how to avoid each one in seconds. Waiting until December. Custodian cutoffs, holiday closures, and mailed QCD checks that don't arrive in time are how penalties happen. Fix: treat November 15 as your hard stop and execute in October after your RMD rehearsal. December is verify only. Thinking transfers count. Selling a fund inside your IRA or moving money between IRAs isn't an RMD. Cash has to leave the IRA to you or go directly to a qualified charity for a QCD. Fix: look for a 1099-R trail. No 1099-R usually means no distribution. Forgetting tiny accounts. A $500 bank IRA still has an RMD. These are the classic misses after moves and rollovers. Fix: add an orphan search to your control sheet and call each custodian once a year to list all accounts under your SSN. January distributions for last year. A pull on January 2 belongs to the new year period. Fix: Put a December 1 status check on your calendar and mark paid only when the custodian confirms the distribution date. Mishandling QCDs. 2 errors: making the check payable to you or doing taxable IRA withdrawals first. Fix. QCDs must go directly from the IRA to the charity, and you do them before any taxable RMDs. Save acknowledgement letters. Layering conversions on peak income. A big conversion in a double RMD year or alongside large capital gains is how you jump IRMAA tiers. Fix. Convert in low-income windows only and never after you've already crossed a tier. Crossing aggregation lines. You can aggregate traditional IRAs and take the total from one IRA. You can't satisfy a 401k or 403b RMD from an IRA. Fix. Mark employer plans in bold on your control sheet and handle them separately. Ignoring mutual fund capital gains distributions. Surprise payouts in December can push MAGI over a tier. Fix. Leave cushion under your IRMAA line and consider smoothing IRA income across months so you can pause if surprises hit. Underdocumenting. Memory won't help in January. Fix. Save prior December 31 statements, divisor sources, calculation screenshots, distribution confirmations, charity letters, and reconcile every 1099-R to your control sheet during reconciliation week. Skipping beneficiary maintenance. Outdated or missing beneficiaries cause inherited IRA messes and missed death year RMDs. Fix. Review primaries and contingents each fall: names, SSNs, relationships, then save a copy with your sheet. Automation without verification. Last year's automated amount won't adjust for your new divisor, rollovers, or QCDs. Fix. Update the automation each fall after you recalc. Reduce monthly pulls after QCDs post. Not coordinating as a couple. One spouse's extra dollar can raise both premiums. Fix. Track A, B, and combined MAGI on your sheet. Assign who QCDs, who draws, who converts, and keep a shared guardrail with buffer. Assuming deductions lower IRMAA. Itemized charitable deductions don't reduce MAGI. Fix. Use QCDs to exclude the income upfront. Deductions come after AGI and won't help IRMAA. Misreading the still working exception. You may delay RMDs from a current employer plan if you're still working and not a 5% owner, subject to plan rules. It doesn't delay IRAs or old plans. Fix. Label current plan possible delay versus old plan normal RMD. Over withholding confusion. Withholding doesn't increase MAGI beyond the distribution itself, but a larger gross distribution to cover taxes might push you over a tier. Fix. Calculate the smallest gross needed to hit your net, then confirm your MAGI cushion. Treating reinvested income as distributed. Dividends and interest inside an IRA don't count until they leave the account. Fix. Don't assume. Verify distributions against confirmations and 1099 RS. Neglecting rollover sequencing. Employer plans often require the RMD first, then the rollover. Fix. Confirm with the plan before moving funds late in the year so you don't move money that should have been distributed. A simple litmus test closes every gap. Do I have a 1099-R that matches my control sheet, a QCD acknowledgement for every charitable dollar, and a MAGI tally still under my guardrail with cushion? If yes, penalties and IRMAA spikes don't have a way in. Forecasting results: what success looks like. Let's zoom out and look at the payoff when the system runs for a full year. The first thing you'll feel is calm. In September, you run RMD week, QCDs go first, the remaining RMDs follow, and your MAGI tally stays under your guardrail. By January, your 1099 RS match your control sheet line for line. No hunting, no guesswork, no uh-oh emails. The second thing you'll notice is a smaller RMD next year. Because you kept faster growth in Roth and steadier income in pre-tax, your traditional IRA balance grew slower, which means your divisor is applied to a smaller number. That trims ordinary income a little more each year, which lowers the chance you bump into higher tax brackets, and it keeps you clear of IRMAA cliffs without cutting spending. Cash flow gets predictable. Premium letters arrive and they line up with the MAGI you projected 2 years ago. When surprises hit, like a mutual fund capital gains distribution, you've already left cushion so you don't cross a tier. That's the hidden benefit of your fall band. It absorbs noise without making you reactive. You also get an estate upgrade. Clean beneficiary designations, separated inherited accounts, and a tidy RMD record mean fewer hassles for your spouse or kids. If someone ever needs to step in, your runbook paragraph, custodian contacts, and folder structure turn a complex year into a checklist they can follow in an afternoon. Here's a short story that captures the feel. A couple ran their first real RMD week last September. They staged QCD cash in the exact IRA they'd use, scheduled checks in early October, and reduced the remaining automated withdrawals so they did overdistribute. They split cash needs between IRA and Roth to stay under their guardrail, then skipped conversions because dividends ran hot. In January, their 1,099 IRAs matched perfectly, and their premium letter landed exactly where they expected. The next October, they had bracket room, so they converted a modest amount and still stayed below their IRMAA line. 2 years later, their RMD had ticked lower, and the survivor preview looked far friendlier because they'd chipped away at pre-tax balances while both were alive. Quantitatively, the rhythm looks like this. Each fall you estimate MAGI, leave a buffer and decide. QCD amount, IRA draw after QCDs, Roth supplement, taxable high basis trim, and only if there's room your measured conversion. You execute in October, verify in 2 weeks, and audit on December 1. Then you reconcile in January, tying every 1,099 R to your sheet. Rinse, repeat. The reason this works isn't magic, it's sequence. QCDs first exclude income, then you blend from the right buckets to hit cash needs without pushing MAGI. Conversions, if any, happen inside space you can afford without touching a tier, and you reposition growth in Roth so next year's RMD base doesn't bloat. Survivor planning shows up as a quieter tax bill later. Because you filled brackets at joint rates while both of you were alive, the survivor's single-tier world isn't as tight. Their RMD is lower, their MAGI is easier to keep under a cliff, and SSA 44 is ready if income dropped for good. It's not about perfection, it's about building a path the survivor can actually follow. If you remember nothing else, remember this picture. 1 page that totals your income, 1 line that marks your IRMAA guardrail with cushion, 1 order of operations, QCDs, blended withdrawals, then conversions only if there's space, and 1 calendar with 3 anchors. That's what success looks like. It's repeatable, it's documented, and it keeps you in control even when markets, mailrooms, and mutual fund distributions do their thing. Quick recap and implementation sprint. Let's lock this in with a fast sprint you can run today. Here's the recap in plain English. 1 control sheet runs the show. Every account listed, last December 31 balances, beneficiary and contingent info, divisor source, per account RMD, aggregated IRA total, and notes on employer plans that need separate polls. Your calendar does the heavy lifting. RMD week in September, QCDs first, conversions only if your MAGI projection says you have space beneath your IRMAA guardrail, a 2-week follow-up to confirm posts, and a December 1 status check. January is reconciliation week. Every 1,099 R must match your sheet. Now the implementation sprint. Today, build your control sheet. Add custodian contacts, account suffixes, and a runbook paragraph that explains your process in 2 sentences. Write your IRMAA guardrail with a cushion. Add a simple MAGI tally, Social Security, pensions, interest, dividends, expected IRA draws, tax-exempt interest, and any planned gains. This week, run a quick MAGI projection and compare it to your guardrail. If you're close, commit to QCDs first and split cash needs between IRA and Roth. If you've got space, pencil a modest conversion amount that fills your chosen bracket without touching the IRMAA line, then stop. Call your custodian for QCD procedures. Get payee formatting, mailing addresses, and cutoff dates. Write them on your sheet. This month, Set calendar anchors, RMD week, 2-week follow-up, reconciliation week in January, and a December 1 status check. Share invites with your spouse or trusted contact. Test bank links with a small transfer. If you'll use withholding to clean up estimates, note the percentage and confirm it won't push your gross over your guardrail. Operational upgrades. Add an orphan search line and call each custodian once a year. List every retirement account under my SSN. Tiny accounts hide mistakes. Add a beneficiary review box. Verify names, spellings, SSNs, and contingents. Save a copy with your sheet. Leave cushion under your tier for December capital gains distributions. If those hit, you can pause remaining IRA income and pivot to Roth. Your sequence for the year. QCDs first, documented. Remaining IRA RMDs correctly coded with withholding dialed. Employer plans handled separately. MAGI checked against your guardrail before any conversion. January reconciliation 1099 RS matched, control sheet signed and dated. That's the play. Small, deliberate steps that keep penalties at zero, shrink next year's RMD, and keep IRMAA quiet. Start the sheet, set the dates, line up QCDs, the rest falls into place. Here's the takeaway. One simple system: map accounts, lock RMD week, do QCDs first, execute early, and audit in January, kills missed RMD penalties and keeps IRMAA under control. If you remember nothing else, stay under your IRMAA guardrail with cushion and verify employer plan RMDs separately. Want the advanced Roth conversion playbook that fills brackets without crossing tiers? Watch the next video. Subscribe for clear, step-by-step retirement tax and Medicare tactics. Start your control sheet today, set RMD week for September, and you'll feel the stress drop fast. End here, go set those 2 dates now.